Hi, I'm Matt from the HMO platform. We help landlords across the UK to get on course towards profitability, wealth and success in an ethical way using our next level HMO and co-living strategies. In this video, we're going to look at commercial valuations of HMOs. Now they're seen as the Holy Grail of valuations by some investors and the mythical thing of folklore that never seems to happen for others. Either way, there's a whole load of misunderstandings about what a commercial valuation is and how it's calculated. So I'm going to demonstrate that today about how we would work out a commercial valuation, and it's based on the way that a couple of the major banks work, the couple of banks that do commercial valuations on HMOs. So we start like this. The first thing we need to know is the rental for the area and for our property. So we can either demonstrate that by having a property which is already tenanted, and we have lots of tenancy agreements that we can use, or what we call ASTs, and we can show how much we get every single month. If we're beating the market rent and we're getting higher rentals than average, then we need to be able to demonstrate that we can get that rent for a long period of time. So even so, I would always be looking to tenant your properties as fully as possible before going for a commercial valuation. So once we know our monthly rent, then we can work out the total turnover for the property for the year. So this might be £30,000 or £50,000, £80,000, etc. And it's the gross total turnover for the property if it were full. Now we need to take off some operating expenses, because like with any business, there are the operating costs which you need to take. They're called the cost of sale. So you can't make that sale without spending the money to buy the elements of what it is that you're selling. So for example, in business, if you're making a mobile phone, you need to buy the bits that make the phone before you can sell it. With a property, the running costs are your electricity, your gas, your water, your internet, all of those costs, when you can't let the rooms without paying those. These costs are our cost of sale that would come off our gross rental figure to create our net adjusted rent. If you know those exact numbers, if you've been operating for a while, then share those with the valuer. If you're just starting the property up, then it's going to be an estimate, and a lot of valuers will give commercial valuations with an estimate between 15 to 25% of the gross rent. Now we generally work on 20% as being a good conservative figure, so take 20% off your gross rent and that will give you a net adjusted rent. And this is our potential profit that we could make from that property if it was bought for cash. But we're probably not going to buy the house for cash, as we're probably going to use a mortgage, and we're also probably going to use a letting agent, not manage it ourselves, and we'll have some insurance costs as well. So there are a few other costs to come off that figure, but let's not worry about that for now, because the valuer does not take those into account. So once we've got the net rent, we need to now know what the yield is in the area. Now the yield of the area is based on the sold prices of other comparable properties, so other HMOs and other blocks of flats. Because a block of flats is a comparable property, because 20 flats or 20 per HMO, they're a similar asset class. So that's what the commercial valuer is looking at to find out what price they have been sold at, but also how much did they turn over. So once you know how much that property sold for and how much that property was making in the year, then you can work out the yield of that property, or what some people know as the multiplier. This is how many multiples of the rent is the sold price. So once we know that, then we can work out backwards what the value, or the GDV, the gross development value of our property is. Some people will also say that this is not achievable and that properties don't get sold at these prices. Well, I beg to differ, because it's calculated using sold prices. So if you've got a commercial based property which makes a profit of £30,000, there are people out there that will pay £300,000 to get a profit of £30,000. That's 10% per year. That's a good return on investment for some people if they're looking to store their money. So it's quite important to understand that commercial valuations are a good way of maximising values, but also returns. Because if we can get most of our money out of a project by uplifting the value of the property, then that also creates a higher return on cash invested. So that's it for this video. Thanks for watching. And if you would like updates on our new releases, then please hit subscribe, and see you in the next video.